Hello and welcome to NorthStar. In the last lecture, we have learned Introduction to Section A. In this lecture, we are starting with the income statement. What is income statement? What is the other name for income statement? What are the two different styles of preparation of income statement under the US GAAP? All of that we are going to learn in this lecture. Income statement. The income statement, commonly called the profit and loss statement. It measures what? It measures earnings of the company over a given period of time. Remember, over a given period of time. It does not measure for one day as in the case of balance sheet. In balance sheet, like I said, we measure everything for one particular date. That is why in balance sheet we write as on. But in income statement we write for a given period of time, such as a quarter or a year. The income statement is used to measure what? To measure profitability of the company, the credit worthiness and the investment value of an entity. Basically, you understand the profitability of the company to take decisions, various decisions. Should you invest in the company? Not invest. Should you lend? Not lend. How do we calculate? Basic formula: income or loss is equals to revenues plus gains minus expenses minus losses. What are revenues, what are gains and what are losses? You need to be familiar with this terminology. Revenues is what we know as inflow from the core activities of the enterprise. For example, you have purchased goods. Is it revenue? No, this is expenses because it is into the core activity. You have sold goods, core activity. But if you sell machinery, you don't record it as revenue. You record it as gains. To tell you the major difference, revenue is a gross amount, gains are the net amount. Remember, we use quite interchangeably in India, but technically if I tell you, the differences are broad. Like I said, when you make sales of goods in trade, you record by sales, gross amount. Do you subtract from here cost of goods sold and directly show net profit without showing sales and cost of goods sold separately? No, we do not do that. But when we sell machinery, do we show the sale value of machinery and then the carrying value of the machinery separately and then we show the profit of the machinery? No, we do not do that. We show it at net value. For example, we sold a machinery for, let's take a smaller value, 100,000, and this machinery had a carrying value of 80,000 in the balance sheet. So we show how much? We show just 20,000 as gain. We do not show this, we do not show this. So this 20,000 is called gains on sale of machinery. Similarly, if we have sold it at a loss, then we show it as a loss on sale of machinery, but we do not show 100,000 and 80,000 separately. But suppose it was goods in trade, then do we show 20,000 only? Answer is no. Suppose it was sales of goods, then we show sales 100,000 separately and 80,000 separately as cost of goods sold. So this way is called revenue and this is called expenses. But if it is not goods in trade, we show only this item called gains or losses. You need to know this difference. Next one, major components and classification of income statement. Sales, I'm sure you are familiar with. Sales means sales of goods in trade. Cost of goods sold means cost of goods sold of that item which we deal in, basically goods in trade. Operating expenses, important. Operating expenses are those expenses which we generally record in the P&L account. For example, selling, administration, marketing, distribution expenses. Remember, operating expenses do not include cost of goods sold. This is a major mistake students do. They by mistake include cost of goods sold also in operating expenses. Remember, operating expenses, yes, it do not include which one? Cost of goods sold. Very good. Then we write other revenues and expenses. Like I said, we will learn about it in great detail over a period. But now just broadly, I am taking you through the entire, the first part of section A. Taxes. We have a broad topic called taxes. Alright, very big topic, little complex topic. Income statement format. Let's get on to little interesting area. Income statement format. There are two income statement. One is called single step income statement. One is called multiple step income statement. Like the name itself says that in single step income statement, you just follow one single step. All your revenues are together and all your expenses are together. Here revenue means revenues and gains. So all your gains and revenues you write it together as one A, and all your expenses and losses you write it as B, and you net it off A minus B, you get net income. You don't show separately gross profit, operating profit, profit before taxes. You do not show any of these separately. We call it single step. US GAAP, you can follow single step income statement and multiple step income statement. Like I said, how does it look like? So you show first revenue. Under revenue, you show sales. You show all your incomings. Sales, dividend income, rental revenue, or any other revenue or any other gains that you have. So here revenue will also include all gains. That is part of your total revenue. Let's call it as A. Remember, like I said, total revenue plus any gains are also there. That gains will also get recorded here. So this together is called A. How about B? In the B, we record all expenses. Remember, here total expenses includes losses. Any kind of losses are also included here. That we call it as B. And we say net income as A minus B. Remember, tax expense is also included in your expenses. So two important things in the revenue, it not only includes revenue but also includes gains. Gain on sale of machinery, gain on sale of land, gain on sale of building, all that will be included, which we in India call profit on sale of land. Technically speaking, it should not be referred as profit. It should be referred as gain, because gains means net number. But it's okay to call it as profit also. Similarly, like I mentioned, all revenues and all gains together, and all expenses and all losses are together. Remember, tax expense also forms part of expenses here as B, and then you subtract A minus B, you get net income. Very, very simple. We will do questions on this, do not worry. Next is multiple step income statement. Under multiple step income statement, we do not show all revenues and losses as one statement, another statement, and net income. We break the entire net income into various calculations to give out more information to the users of financial statement. For example, you as a user wants to know how much is the gross profit of the company. Now, in the single step income statement, you will not know. You have to take the single step and you have to calculate yourself to find out how much is the gross profit. You have to calculate what is the operating income. You have to calculate everything. But in the multiple step income statement, the company itself gives you all the necessary information which you may need to make better decisions. Let's go into it. Net sales less the cost of goods sold, we get gross profit. You need to know this income statement quite clearly. You need to memorize this income statement. So remember, you need to memorize this income statement. All right, very important format. First, sales less cost of goods sold. Keep telling with me so that you remember. First is sales less cost of goods sold. What do you get? You get gross profit. This you are perfectly familiar with. Sales minus cost of goods sold. What do you get? Gross profit. From gross profit, we subtract operating expenses. What does operating expense include? It includes selling expenses, general and administration expenses. Comfortable? What do you get? So, gross profit minus operating expenses, you get operating income or operating profit. You can call it operating income or operating profit. Let's repeat once more. Sales less cost of goods sold. Keep telling with me, keep repeating with me. Sales minus cost of goods sold. What do you get? You get gross profit. Gross profit minus operating expenses. What do you get? You get operating income. Very good. From operating income, we add interest and dividend income. Remember, interest and dividend income. This is very important because separately in another topic I will use it. So keep remembering, operating income, add interest and dividend income. But while subtracting, we subtract only interest expense. We do not subtract dividend expense. Why? Later I will tell you. For now, just understand
While subtracting, we subtract only interest expense, not dividend expense. Not the dividend expenses. Dividend expenses will not come inside the income statement at all. Where does it go? It goes in the balance sheet. Alright, where does it go? It goes in the balance sheet. Dividend expense do not come inside the income statement at all. Will you remember? Yes, let's start again from operating income. Operating income, add interest and dividend income less interest expenses, and then we add or subtract any non-operating gains or losses. Non-operating gains or losses. Gains and losses, I have already told you, net number. Machinery 100,000 sold for 80,000, you have loss of 20,000. Machinery sold for 100,000, carrying value was 80,000, you sold for a gain of 20,000. So here we are going to write these gains or losses. Remember, these are non-operating gains and losses. What are non-operating? Non-operating means those which are not part of your day-to-day core operation, or we call it goods in trade. Or operating activity means day-to-day business activity, the activity which is important to carry out your routine business operations. Alright, so these are non-operating gains and losses. From there, what do we get? We get income from continuing operation. What is income from continuing operation? That part of the business operation which I am not going to close in the next coming future. Alright, continuing operation means that I am not closing down any of the business unit or any part of the business. That part is called continuing operation. Then what is discontinuing operation? Any part of the business which has been discontinued during the year is called discontinued operation. Remember, income from continuing operation will be presented or written separately only when you have discontinued operation during that year. For example, you are dealing in 10 line of business, 10 commodities, 10 goods you sell. All the 10 goods have a good market share, but one of the product, one particular product you have discontinued during the particular year. One product. So you are continuing with how many? 9. Alright. So those 9 will be mentioned here, income from continuing operation, and that one product what you have discontinued, that will be shown below. Alright. That is why we show income from continuing operation. And remember, this is always presented gross of tax or before income taxes. And after that, you subtract provision for tax. Remember, it is not tax paid, it is tax expense. Tax paid are different. We are recording only provision portion of the tax here, not the payment portion of the tax. Payment portion can be more than provision, can be less than provision. So remember, we record which one? Only the provision for tax, which is recorded as tax expense. Expense means all those amount or items which are recorded in the income statement, we call it expense. Alright. Now, then we get income from continuing operations. After that, those 2 points are very, very important. The next one, add or less gain or loss. When I write it without bracket, I am talking about gain. When I put bracket, I am talking about this one, loss. So gain or loss from operation. Operation of what? Discontinued operation. For example, we discontinued one product. Alright. So that one product we discontinued during the year. So we continued with that product maybe for 5 months. So during that 5 months, how much you earned or how much you lost? The net amount, the gain or the loss portion only, the net amount. That portion will come here. Operation. Operation of the discontinued operation. Means for the 5 months you continued selling that product, how much you earned or lost during that 5 months. Remember, this is to be presented net of taxes. Very, very, very important. This has to be presented net of taxes after subtracting the tax. Next one, gain or loss from disposal of discontinued operation. Means after 5 months, what will you do with that unit? What will you do with that machinery? You may sell it off. So when you sell off that entity or when you sell off that machinery that belongs to that entity, what is the gain or loss that you got? That will be recorded here. Remember, I have bolded gain or loss from operation and gain or loss from disposal. Both has to be presented net of taxes. Or other way of presenting it, show gain or loss from operation and show gain or loss from disposal, and on these two whatever tax has come you write here and then show net. So you can show it like this also, or you can show this one only net of tax, this one only net of tax, then you don't have to show this separately. But remember, gross of tax can never be shown here. Alright, will you remember? Yes, very good. Note, important note, FASB accounting standards removed the concept of extraordinary items under the US GAAP. So there used to be some concept called extraordinary item. Now this concept has been completely removed under the US GAAP. For both public companies and private company, a separate net of tax presentation is now not allowed. So remember, extraordinary item concept has been completely removed from the US GAAP. Does such concept exist under the IFRS? Answer is yes. Extraordinary item continues to exist under the IFRS, but under the US GAAP this has been removed. Next page, presentation of extraordinary item. Like I mentioned, extraordinary item concept has been removed, but what will we do with those items now? Where do we present it? So that is mentioned here. After removal of the concept of extraordinary items, an entity now is required to present that of unusual and non-recurring or infrequently recurring items on a pre-tax basis. Remember, it has to be shown before taxes, and where it is to be shown. So it should be shown within income from continuing operations. So earlier it was shown differently. That concept has gone under the US GAAP. Now you have to show it as part of income from continuing operation. Do you remember? Yes. Means it should be shown above this item, ideally under this heading, under non-operating gains and losses, under this heading. Will you remember? Yes. So all extraordinary item now has to be presented here. Now it is very simple. How do we compute net sales? Why do you need net sales? Remember, the first item was sales. Sales means net sales there, right? What is net sales? Sales minus any discount or allowance for sales discount minus any sales returns. Alright, all sales return minus sales discount and allowances for sales discount, we get net sales revenue. Next one, computation of cost of goods sold for a retailer. Very important, you have to remember this for a retailer. Remember, who is a retailer? We call them as trader also. Means retailer or trader means those sellers who buys and sells goods. Who buys and sells goods, who does not manufacture. Alright, those who just buys and sells, who do not manufacture, are called retailer or trader. Then who are manufacturer? Those who buys raw material, converts the raw material into WIP, then to finished goods and then sells. Those are called manufacturers and not just traders. Alright, manufacturer may also be a trader, because after manufacturing, of course, they will be selling, but we will refer to them as manufacturer and not as trader for simplicity purpose. Let's come to this. Computation of cost of goods sold for a retailer means he will not have any raw material, he or she may not have any WIP. All that he or she may have is finished goods. Simple. So, opening stock or beginning inventory. Add purchases. Purchases means net purchases. What is net purchase? Purchase minus purchase return is called net purchases. Remember, we always add freight inward. Whatever freight we have paid for purchasing the goods will always be added to the cost of purchases. It is never recorded separately. Never. So opening stock plus net purchases together with freight is called cost of goods available for sale. This is an important term. Quite a lot of questions will carry this terminology. Cost of goods available for sale means how much goods you have which you are ready to sell. From there we subtract closing stock, and what do we get? We get cost of goods sold, which we call it as COGS. So remember, opening stock, repeat with me, opening stock plus purchases plus carriage inward. Opening stock plus purchases, purchases here means net purchases, plus carriage inward, together we get what? Cost of goods available for sale. From this we subtract closing stock value. What do we get? We get cost of goods sold. Will you remember? Yes, you have to remember. There is no escape because it is constantly tested in exams. Computation of cost of goods sold for a manufacturer. So far we learned cost of goods sold for a trader. You found that little difficult. No, I'm sure you did not find that difficult at all, because this is going to be little more lengthy for you. Are you ready to learn it? Tired? Don't worry. Just few more topics for today and then we will start again in the next lecture. Yes, first one, computation of cost of goods sold for a manufacturer. Opening stock of raw material, then we add what? Net purchases. Which net purchases? Raw material. Because I am a manufacturer, I will not purchase finished goods, I will purchase raw material. And then add freight and subtract closing stock of raw material only. Very important, raw material here. Raw material. Comfortable? So, raw material opening plus purchases plus freight minus closing stock of raw material. What do you get? You get direct material used in production or raw material consumed. Or raw material consumption. From raw material what you have consumed in production, you add direct labor and any kind of manufacturing overhead. Remember, fixed as well as variable. Manufacturing overhead. These manufacturing overheads are absorbed. Alright, these manufacturing overheads are absorbed. We also use the word recovered. Absorbed means absorbed in cost of production. So, direct material consumed, add direct labor, add manufacturing overheads. What do you get? You get total manufacturing cost. Remember, the first word is very important. In India, we generally use the word gross works cost. What is more important word for you to know? Total manufacturing cost, because that is the word which will be tested and used quite frequently. So, from total manufacturing cost, you add opening WIP and subtract closing WIP. Remember, add and subtract. First, you always add opening and subtract closing. So, remember, whether it is raw material, WIP or finished good, we add opening and subtract closing. So, add opening stock of WIP, work in progress, and subtract closing stock of work in progress. What do you get? You get cost of goods manufactured or works cost or net works cost. Important word is cost of goods manufactured. Remember, here it is called total manufacturing cost. Here it is called cost of goods manufactured. Very important difference. Looks very similar, but difference is very, very significant for you. From that, you add opening stock of finished goods and subtract closing stock of finished goods. Remember, first one was raw material, then came WIP, and then comes finished goods. Alright, in all the three stages, opening stock was added and closing stock was subtracted. Yes, very, very important statement. You have to ensure that you remember all the steps in this statement. Very, very important. So, mark this very important statement from exam point of view. Yes, ready for the next one? Let's go on to the next one. Important, like I mentioned, wherever it is important, wherever I see students getting confused, I try to explain that through an important note. Income from continuing operation on a multi-step income statement is not the same as operating income. Remember, lot of students get confused between operating income and income from continuing operation when it is asked in the question. It is important that you know that these terms, though it may sound very similar, are not the same at all. What is the difference between the two? Let's go back and check out our statement. So, we have done operating income. From operating income, we add interest and dividend income. We add and then we subtract interest expense. And we also add or subtract non-operating gains and losses, and then we get income from continuing operations before taxes. So, is operating income and income from continuing operations same? Answer is not at all. It will never be the same. Alright. So, remember, same thing I have explained here. is not the same as operating income. Operating income includes revenues and expenses generated by the company's core business. Operating income does not include financial income, interest and dividend income, or financial expense. It also does not include non-operating gains and losses. Alright, non-operating gains and losses. And last one, gains and losses on disposal or operation of discontinued operation. Let's go on to next one, non-operating gains and losses. What are non-operating gains and losses? I have explained those which are not part of the core business operations of the company. Any gain or loss on non-core business operation are non-operating gains and losses. Remember, they are combined together and shown separately in the income statement. Additional income statement presentations for irregular items. Those items which are irregular, how are they shown or disclosed or recognized in the financial statement? So first one, discontinued operation. I have already explained this. In discontinued operation, two things comes into picture. First is operation of the discontinued operation, and second is disposal of the discontinued operation or the component of the discontinued operation. Both has to be reported, gross of tax or net of tax. So yes, you are right, both has to be presented net of taxes. Remember, important word, operation net of tax and disposal net of tax. The term income from continuing operation is used only when discontinued operation is reported during that period. If discontinued operation is not reported during the period, the enterprise shall directly report net income instead of showing income from continuing operation separately. Alright, the enterprise shall directly report what? Net income, means you don't have to write continuing operation. This is not there, this is not there. Instead of writing income from continuing operation, you write directly net income. Comfortable? Yes. Major income statement note disclosure. You don't have to memorize anything here. You just need to know that these are items which needs to be disclosed in the income statement. The first one, EPS. We will be learning in great length about these. But for now, just remember these needs to be disclosed with the income statement. First, earnings per share. Next is the depreciation schedule. Components, the breakup of the income tax. And last one, the components of the pension scheme. Alright, remember these are major items. This is not the exhaustive list of disclosures under the income statement. These are the major items which needs to be disclosed along with the income statement. Next one, advantages of income statement. The income statement helps to predict the future cash flows. It provides a basis for predicting future performance. It helps users assess the risk, assess the uncertainty of achieving the future cash flows. These are information which are available to the users by reading the income statement and comparing this income statement from the previous year's records, which are presented together like I mentioned. It helps users to evaluate the company's performance, the past performance, and assess the current performance to predict what could be possible performance in the future. So it gives you a benchmark to not only assess the past performance but also foresee the future performance of the company. The last one, what is the limitations of income statement? This is the last topic, and then we will catch in the next lecture, right? So don't run out of patience. We will be going slow, smooth, and topic by topic we will be learning. Limitations of income statement. It does not show all items of income and expense. Some of the items are reported in the statement of comprehensive income. So remember, what is statement of comprehensive income? We will learn it separately, but remember, in income statement, every item does not get reflected. The next is, it is prepared on accrual basis, not on cash basis. So there may be net income shown in the income statement, but you may not have sufficient cash as mentioned in the net income. For example, there are a lot of credit sales. Net income is showing 5 million. But all the credit sales has not paid you money. So will you have 5 million in your hand? Answer is you may not have. So income statement do not show you the cash position. It carries items which are merely an estimate and management judgment, such as the amount of depreciation. So there are a lot of items in the income statement which are just an estimate, and like I mentioned, estimate may change with your experience. So these are estimates, these are not sacrosanct numbers. So this is the third limitation of the income statement. Now that we have completed the session on income statement, let us quickly recall the important topics that we must remember. The first one, the preparation of income statement under the single step income statement and multiple step income statement. In addition to this, you must remember the format of computation of cost of goods sold for a manufacturing entity. Remember the three important terms that we used: the total manufacturing cost, the cost of goods manufactured, and cost of goods sold. Remember, this is constantly tested in exam. And the last point is computation of cost of goods available for sale and cost of goods sold for a retailing company or for a retailer business. In the next lecture, we are going to solve some questions based on the concept that we have learned so far. See you in the next lecture. Bye-bye and take care.